There is a reason why some of the most high-profile executive conflicts in recent American history have involved people like Adam Neumann of WeWork and Travis Kalanick of Uber. These are situations where founder CEOs have been forcefully ejected by boards and shareholders after the company's IPO because what they were doing was in their own personal self-interest, but not in the interest of the company or the wider community that they were serving. What is our stance? Firstly, we regret the norm that company founders, like the initial founding team of a startup, for example, remain in key executive positions after an IPO. We also regret the fact that they often retain significant ownership or controlling stakes in the company, and we would much rather there be a norm where they give up some effective control to some kind of professional management. Even though this is not the motion, we think that it's closely related. Third, we think that professional management, which is our alternative, doesn't necessarily mean like MBAs and B school types, but it could also refer to individuals that rise through the ranks of this company, people appointed by external shareholders, and so on. We're going to forward two arguments. First, that this norm is worse for society more broadly. Secondly, that it's worse for company management and therefore worse for the shareholders of the company. The first point is obviously the most important, so I'll spend more time on it. So, before then, what does this norm look like? This is not just about founders choosing not to leave and remain in company management due to profitability, or because shareholders believe that this is profitable. We think the reason why this norm exists and what this norm actually looks like is shareholders choosing not to force company founders out, even though it is bad for the company, because the norm means that it looks bad immediately after a company has IPO'd for shareholders to engage in conflict with management and force the founding partners to exit the company. We think the norm exists for this very artificial reason that it's just considered bad PR rather than, like shareholders deciding that it's necessary for profitability reasons for the founder to remain. Also, this norm has been driven by like a few very high-profile success stories, like Larry Page of Google, for example, which for the reasons that we'll discuss are not replicable in the vast majority of cases. This norm is driven by an artificial cult of personality around genius founder CEOs that we think is just doesn't necessarily faithfully represent this real situation at the vast majority of startups that IPO. Also note that most startups that IPO are like weird like pet care companies or like some kind of e-commerce service that don't necessarily provide such a large-scale service to people, but nevertheless have an important stake in communities and where like the founders' vision may be at odds with what is best for the company and shareholders. So, why is this bad for society more broadly? Firstly, we think that often celebrity CEOs choose to forward their own personal interest and their interests of their own public image above that of society. And we think that this can come to things like growing at all costs. We think the mindset that allowed founders to build businesses that are able to IPO in the US is incredibly toxic. It means chasing growth at all costs, like for example by undercutting competitors, by using gig economies to drive like salaried workers in the taxi industry out of business, for example, in order to rapidly gain market share. We think that on the comparative, if these people exit the company and exit management positions, shareholders will be the one that decide what to do. Why do we think shareholders are comparatively better decision makers in this case? The shareholders of large public companies are often large mega funds like BlackRock or Fidelity. These represent the interests of pension funds, sovereign wealth funds, which care a bit more about social interests and the impact on wider society. Perhaps they are still profit motivated, but to a lesser extent, and certainly in a less toxic way than founder CEOs. The reason is because they, firstly, they represent these people like pension funds, but also because like these large institutional asset managers own a large number of companies, so something that undercuts stability, like for example Facebook undermining democracy, is bad for the larger portfolio of companies that they own. Also note that currently there is a large push for ESG investing. Consumers demand that many of these funds invest in a way that is responsible, that respects the environment. That's why the SEC mandates environmental disclosures for all these large public companies and socially responsible investing. So we think that the conflation of these factors means that on the comparative, shareholders are far better decision makers, and these are the people who will have management, who will like appoint the new management. Yes?
Suppose that shareholders do have all of these great incentives. If companies on our side still go to IPO, presumably they still carry lots of weight in board deliberations.
Sure, but we think that the founder CEO, just because this norm exists, because they can point to the fact that they founded the company, that this represents their vision, will have more weight and they have a greater ability when this norm is in place to overpower shareholder interests. Why is the second reason why this is bad? It builds a cult of personality and celebrity around CEOs. We think that owning a public company gives you a unique platform because you're interviewed more often, not like Jim Cramer, you appear on earnings calls. There's just more public attention around you when you are a company that is IPO. This allows big CEOs of these large companies after the IPO to gain a greater public image as someone who is a genius, as someone who built this company from the ground up, and this allows like Elon Musk to succeed, people who build huge celebrity followings to have a cult of personality around them that makes them essentially untouchable. This leads to the obvious problems in a moment actually of things like political capture and also the fact that they can influence domestic politics on a larger scale.
Sure, this is to a degree non-comparative. Like if the IPO is super successful and super useful anyway, a new CEO is also going to be invited onto Jimmy Kimmel anyway.
Yeah, sure, but we think that this new CEO is now a professional manager. He's not someone who can claim to have been so independently successful to have like this own self-made entrepreneurship story of of like building the company from the ground up. So we think that we reduce the the cult of personality around these Silicon Valley figures, which we think is incredibly pervasive right now. Also, we think that another consequence of the cult of personality is that it just becomes harder to push them out from within the company, right? People like Adam Newman, for example, if they eventually make mistakes further down the line, it's harder for like shareholders to push them out because they have been like the CEO both before and after the IPO. We think that thirdly, this reduces innovation. The comparative advantage of founders is in things like fundraising, building novel technologies, not managing a gigantic public company. So even if we admit that people like Elon Musk are valuable for society, we think that it's better if they focus their efforts on building like new businesses and new business ventures, rather than necessarily speaking like managing a gigantic public company with hundreds of thousands of employees. That's why all legacy businesses that have been earlier than this tech boom, like for more than 30 years, rely heavily on professional managers whose skill set is understanding the needs of the company and how to manage as large organizations. Finally, this stops the culture of IPOs before companies are ready, because owners realize that once they leave, the company will be in outsider hands, so they have an incentive to make sure that at least it is profitable because they care about the legacy they leave behind. They don't want the company to fail right away. And also because bankers and like VCs won't want the company to IPO if it's solely dependent on like the founder's charisma, right? So we think that they have an incentive to make sure the company is sustainable before it IPOs, and we have less like money-losing public companies that are bad for shareholders and society. Secondly, about company management, and I think I've already discussed many aspects of this, but let me deepen this analysis. We think that firstly, founders' mindsets are of course growth at all costs. They are not suited to manage like a gigantic public company with things like where more time is spent on like disclosures and like working with the SEC rather than building new products. And also we think that often company founders have an internal vision of what they want their company to look like, and it's very hard for them to deviate from this vision. But often managing a public company where you have to be more accountable to regulators, where you have to slow innovation, and where you might have to pivot after 20 to 30 years is something that is incredibly important for many large public companies. So we think that it's more sustainable in the long term if they give up the reins to someone who is better able to understand the company's needs as it stands as a public company, rather than their own internal, rigid, and inflexible vision. We're proud to propose.
I thank the Prime Minister for that speech. I invite up the Leader of Opposition. Here.
I think our case is going to be quite simple, but that's just because it reflects the reality of the world, which is that the norm of having founders stay in key positions in these companies is not only beneficial to society, but as a whole beneficial to the innovative process and technology that we want to see from companies. In the status quo, there is an all-time high of corporate profits, yet an all-time low of spending in R&D. And the reason why we say that this is the case is because more and more influence is being put into the short-termist incentives of institutional investors. We would much rather retain more power in the hands of founders, who oftentimes are the only ones holding on to the idealized visions that can create groundbreaking innovations. Two things in my speech. Firstly, I want to do the comparative of whose incentives are more likely going to be in line with benefiting society, and then engaging mostly with everything OG tells us. And then secondly, I want to explain to you why it is that it makes it harder for the best companies to gain access to capital when IPOing necessarily entails founders losing their jobs. Firstly then, on the comparative, right? I think the first thing that we have to understand is how most IPOs work, right? Most IPOs involve giving up a large portion of your shares to the market. That is to say, generally this looks like the institutional investors that they talk about who, you know, on their side they say they are mitigated by their other investments in pension funds, right? The reason why on a comparative level these people are more likely going to be short-termists is a fewfold. The first thing to point out is that generally the way this works is that many times these institutional investors will put in elected people to the board to represent their interests. But because institutional investors only need to care about making profit before they sell off the stock, they don't really actually care about the end outcome or the end goals that the company has in its vision. They only care about making profit. This then becomes highly problematic when it looks like creating trade-offs between putting more money into R&D versus laying off workers when it comes to changing your profit margins in the short term versus taking temporary or short-term losses for long-term gains, right? An example of this might be, for example, when Jeff Bezos was able to retain control of Amazon. And for a long time, he was able to hold losses because he understood what the potential of the company was, even though privatized investors always were pushing for him to create short-term profits. The response that we get from opening government here is that shareholders care about society, they invest in pension funds and real estate, and they have ESG protocols. There are so many issues with this argument. The first thing to point out is that, like, even if it is true that they're invested in pension funds, they still make massive amounts of money off of short-term opportunities. And the reason why even these long-term opportunities aren't at all going to be affecting them is because they oftentimes also profit off of short-term variation in inflated markets. This is why things like arbitrage allow for these hedge funds and these private capital, private equity companies to be able to make money off of the fact that people panic, regardless of whether or not they're actually creating any type of value for the market. These hedge funds and these private equity firms also have things like insurance, where they pay millions and millions of dollars every single month just in case there's a recession, and then boom, they're able to profit. So they're actually hedged much more so against long-term threats than any of the individual investors who are more likely, like founders, who are more likely going to be invested into the long term, right? I mean, this is like why Jane Street was able to make billions of dollars during the COVID pandemic when everybody else was losing all their money, right? So at the end of the day, it is just fundamentally not true that these these institutional investors have any real incentive for the long term. Even when it comes to ESG practices, it tends to look like things like marking up the price of solar panels to make more profit rather than creating better and more efficient and innovative methods to produce them, just simply because they would much rather have a shorter holding that guarantees their profit because they have an exit when other people don't, because their vision is tied to the project. Comparatively, what do we think founders look like? I think there's three main things to point out here. I think firstly, founders are almost always going to be more invested into the idealized version of what their company goal was. And the reason why this was so is because they took on a huge amount of personalized risk and personalized investment in order to create this endeavor in the first place. So sure, they might argue that some founders are also short-termists and will like to have a cash out, but on balance, there are reasons why founders are much more likely going to be, in any situation, more invested in the vision. The second thing to point out here, though, is that founders are also likely to have buy-in from key figures within the company, right? Oftentimes, this is the rest of the board. These are the people that are able to make the company function because multiple dissenting groups within the company are all aligned under the commonality of this individual's personality, right? And this notably addresses the idea coming from Arthur about, like, these founders oftentimes having too much influence. Oftentimes, the reason why these companies are successful and are able to convince institutional investors to invest in them is because they're currently functioning at a level that these individuals are crucial to. The last thing to point out here, though, is that these founders are often the type who attract more beneficial types of investment. That is to say, these are the type of people like Jeff Bezos who can convince more long-termist investors to come in, people who are willing to take on losses for years on end and realize the eventual outcome, which is that they produce something that is much more beneficial and much more efficient to society as a whole. The impact of all of this then is that on net, we would say that when you get rid of the norm of allowing founders to keep C-suite positions, you lose out when it comes to things like long-term investments. You're more likely to spend money on marketing than you are going to on R&D. You also are more likely to hurt the workers within these companies. That is to say, wage growth always decreases after companies IPO. You also see massive layoffs being a much more favorable trade when your new CEO is an ex-McKinsey person rather than the founder who grew his company with the existing employees. All of this necessarily means that corporations tend to take on a trend of having, on their side of the house, are more likely going to take on a position where they prioritize profits rather than the innovation and technology that we think they can push the boundaries with. I'll take a POI from both. Opening?
Yeah, the companies on the stock exchange with the highest market cap now have been money-losing high-tech companies. It is just not true that investors care only about profitability because they like the stocks in their portfolio to have a high valuation.
Yeah, and the reason why they're able to do this is because those founders have stayed and that they've been able to attract the VC and the angel investors who are willing to stay with them for the long term, whereas the institutional investors don't have the incentive because I told you they're hedged against risk and they don't have long-term incentives. Sure.
Yeah, the point at which you make the decision to go into an IPO means you recognize that the company needs something different. Why should we still prioritize the idealized versions of
Right. I'm getting to that exactly right now. So here's the thing, right? On either side of the house, companies are still going to want to have access to capital. What then is the delta in the change in incentives on their side of the house? The key change now is that founders realize that an IPO is not an available option for them to gain access to capital if they want to stay in power. What then are they going to do? They're going to either take on expensive loans or they're going to take on private investment at a much higher percentage of their share. Oftentimes, these more expensive investments investment opportunities mean two things. Firstly, just that better companies that have more long-termist visions have less access to capital in the first place because they get, like, one option is taken away, right? You no longer can gain capital from an IPO. But the second and more important thing is when more companies are forced to thus take these loans, it also increases the cost of capital, which means on net what they basically do is essentially is a market shift where more and more investment is going to be short-termist and there's going to be less and less available capital for companies that truly are able to create groundbreaking change. At the end of the day, the capitalist system is fucked right now because it heavily incentivizes profit and heavily decentivizes innovation. We're so proud to oppose.
I thank the leader of opposition for that speech. I invite the Deputy Prime Minister. Here, here. Thank you.
Everyone good? Two things in my speech. First, I'll talk about the effects on the company, and second, I'll talk about the effects more broadly on society. First, on the effects on the company. And it's really important in the short term for the company's incentives more broadly and the incentives of shareholders and institutional investors in the aftermath of the IPO to be aligned with the CEO's incentives, even if we accept that those incentives are fundamentally worse. And the reason why is the comparative, which is the comparative in a lot of these companies is that CEOs and individuals in positions of power, including founder CEOs, are often forced out anyway after a brief period of management. And there are two reasons this is substantially more damaging than the option of them not becoming CEOs in the first place. The first reason is because it is deeply damaging to the company to have a major prominent conflict that substantially undermines its stability, causes the stock price to suddenly fall when the CEO is being forced out rather than a point where they voluntarily choose to resign and you make a meaningful transition. The second is it's a sudden shock where you basically have an unprepared executive taking a position of power over them. Why is it likely then that the effects on the company itself are overwhelmingly negative? Opening opposition's first claim is that there's more buy-in from key figures within the company, meaning this kind of push-out is less likely to happen. The first response I would make is that the board and the shareholders are way more involved in picking an alternative replacement CEO than just sticking with a founder who they had no power over but didn't want to initially force out of the company because they're the ones whose brand name came with the company in the first place. The second, though, is that in many cases this increased buy-in leads to never calling out the CEO when they make poor decisions, which is if you shape company culture at the employee level and they end up making poor decisions that cause the stock price to eventually fall when you realize the company's profits are not as high, that makes it more likely the board is essentially, the hand of the board is essentially forced and it's forced to push the CEO out. None of this engages with Arthur's arguments for how fundamentally these managers just struggle to adapt. First, they have to radically shift their management style from a point of low survivability, a point where they were aiming for rapid growth, to a point where they've reached their IPO, and the key is ensuring their company remains stable and is able to attract funding. The fact that they often lack experience, the fact that additional innovation at the company often has to come with diversification, that is, expansion of the company can never often stick with its original or business model, and therefore founders being attached to their original vision of a company often means the company struggles to expand because it struggles to diversify into things that aren't focused on that founder's individual vision. All of this means, even if you accept all their arguments for why shareholders' incentives are fundamentally worse, this conflict in incentives can lead to the same outcome of founder CEOs being pushed out in a substantially worse way. With this out of the way, let's talk, no thank you, about social effects. The first claim they make is that investors are fundamentally short-termist and founder CEOs are long-termist because investors care about making profit before a quick sell-off. Three responses. One, they often sell off to people who will hold the stock. So even if you have an infinite chain of people selling off the stocks, remember that the value of a stock is the expected value of long-term future dividends, not the dividends that you immediately get because the company literally isn't able to pay you dividends immediately after the IPO. What that means is, at some point during this musical chairs chain that they described, shareholders have to be aware that the stock has some capacity to pay off dividends in the future, which means especially at the point immediately after an IPO, often a point, by the way, where the company isn't even profitable yet, it's really important to know what the long-term future valuation of that company looks like and pricing in what the stock is. No, thank you. But second, in many cases, these shareholders do often hold stocks. They don't immediately sell it off, or they don't expect immediate profits, because for most companies that immediately got an IPO, they're not profitable at the point of expanding an IPO. Remember, even if you get a large amount of funding, you still need to establish yourself in the consumer base and accumulate large amounts of profits, which takes time even from the point where you, for example, reach something like a unicorn $1 million valuation or $1 billion, I don't know. And as a consequence, you're often like literally not profitable at the point where you're a unicorn jumping into an IPO, and therefore none of these institutional investors expect you to be immediately profitable. What they expect is for you to become profitable in the future. If they don't have that expectation, that's when they dump your stocks and your stocks go into free fall. The third is that founders generally leave in the very long run. Like Larry Page is not the CEO of Google anymore. Like Jack Dorsey already left the CEO of Twitter before Twitter was sold to Elon Musk. And therefore founders don't have these incredibly long-termist incentives either. Their second claim is you don't create innovation, that founders are tied to the initial notion of the company and therefore they care about innovation. A couple of responses. First, new innovation, as I said before, involves diversification. Usually a startup starts off with a couple of innovation or a couple of new products they introduce into the market. But for example, if you innovated Google search and you as Larry Page are really tied to the idea of Google search existing, then maybe as Larry Page did when he was CEO of Google rather than Alphabet, you don't care as much about expanding Google Brain or the other R&D opportunities that Google has, because your initial vision of the company is the initial innovation that you had rather than additional innovation that the company is capable of. But second, flip this argument. In many cases, spending on R&D doesn't immediately mean there is massive growth opportunities for society. Indeed, R&D spending comes with massive risks for society. I'll go over that before that. Closing a POI?
Not at the moment.
Okay, you?
All right now.
Okay, no. Well,
Okay.
okay. Yeah?
Yeah, I just think that like political capture though is so much easier when you have someone who doesn't care about the company and is willing to be bought out by politicians.
But political capture is substantially easier when you have an individual shareholder or an individual founder CEO who often has political opinions of their own. It's also way more dependent on things like politicians for regulatory things when you don't have things like networks and connections in existing regulatory agencies. Anyway, excited to hear your extension. Yeah.
Your response to short-termism is just that you can make profits over a 5-year horizon, definition of investment. There is still a difference between increasing prices and investing in something with an uncertain possibility of success, and that is empirically the direction the markets have been moving.
But increasing prices isn't necessarily profitable if your product hasn't caught up with the consumer base anymore. You need innovation to make your product reliable. Simply increasing your prices isn't sufficient, especially when like your product, like demand elasticity will catch up. Okay, the second thing we tell you though is that these companies are often likely to pursue really risky routes of innovation that increase the risk of either the company failing, engaging in the layoffs that they talk about, or engaging in practices that lead to broader social risks. The reason why is because these founder CEOs come from a culture of risk-taking. They're used to trying to scale up a startup and take as many risks as possible. They seek funding from angel investors who also come from this very culture of risks and VCs rather than seeking ordinary funding modes. And they were taught by like Y Combinator or whoever incubated them that taking risks is the way to grow, adapting away from this is hard. Finally, on the claim that you simply won't go to IPO, I have a couple of responses here. The first is that in many cases, going to IPO is seen as the logical extension of a company. This is what you were taught when you started scaling up the startup. The fact that you need an IPO for your company to sustain, you still cared about your company getting a big valuation, you getting another private capital source and going the same route you have all this while is not worthwhile. But second, we actually think this is good. It is good for founders to pick a growth model where you aren't immediately reaching a $1 billion valuation and jumping your startup off to IPO, but instead picking a slower, sustainable growth model where maybe you're at the top for a little more time, but your company gets an IPO later. Suppose.
I think the Deputy Prime Minister, I invite up the Deputy Leader of Opposition. Here, here.
Okay. Everyone good? I'm going to start. The first thing I'm going to do is take the argument that Brian made that they chose to ignore in the last speech, and that I think independently wins this debate, and I'm going to make it. I'm going to explain why it wins the debate, and then we're going to deal with the mess of opening half. So, what have they told you? They've told you that when a CEO is in charge, they have a cult of personality, they have no regulation and no accountability, they take excessive risks, they don't work with regulators like the SEC, etc., etc. They talk about Elon Musk. Is there an example of Elon Musk doing this that rings a bell right now? It's Twitter, and it's a private company. What we told you is that it is far worse for these companies to stay private than it is for them to go public. Because when they go public, they will face some amount of accountability and some amount of scrutiny. But there will be far fewer companies that choose to go public, particularly companies that are driven by innovators, that are driven by the VC types of people who want to change the world, and that is going to lead to a far worse outcome than our world, where even if the CEO has maybe marginally more influence than he or she should have, there will be several counterweights that keep that company in check. So, what happens if these companies do not go public? Brian told you two major things. The first thing he explained to you is it's going to be harder for these companies to innovate, right? And the reason why they're not going to go public is quite simple, which is that if the CEOs are the kind of person that they have described, they would absolutely not want to give up control. It's implicit in all of their warrants. And if they don't go public, it means that they're going to have to pay far more for any new investment, and they're going to get far less investment when they don't have access to the public financial markets and trillions of dollars of highly liquid capital. The consequence of that, they cannot invest in the kinds of things that make those companies innovative, and even if they can invest in things, if they have to borrow at a 10% interest rate instead of a 5% interest rate, it means the bar for the things that they can invest in is substantially higher. It means that their discount rate is substantially higher, which means they have to place far more of a premium on the short term than on the long term, because they'll have to pay large amounts of interest every single year if they're waiting 15 years for their groundbreaking biomedical innovation to materialize later. The second major harm, though, that I want to elaborate on is that this is much worse on all of the metrics that they have described. Specifically, there are still massive ways that you can check back on these companies regardless of who the CEO is once the company is public. There's things like SEC regulation, which is an example that they cited, that just applies to public securities. It doesn't matter if Elon Musk is a CEO or not. There's things like information disclosures, like the 10K form that you're required to file that forces you to use consistent categories to report where is your revenue and your profit coming from. Is your company actually having long-term potential, or is your accounting practice broadly fraudulent or broadly misleading? You also agree via the incorporation of information and disclosure to the market being able to impose discipline on you if your company is moving in a radical direction, or if your company is posing massive social risks that the supposed ESG investors do not like. And these are all things you're still going to want to respond to regardless of who the CEO is. When your company is private, all of this goes away. You don't have to disclose. You don't have to mark your profits to market, which means that there can be huge amounts of information that are withheld, and then, 5 years later, everyone finds out about this problem at once, and your company is wiped out overnight. We think that the margin of harm on these cases is significantly larger than the marginal change that occurs for companies that are already public, and this is therefore a game-winning argument in and of itself. Go.
Great impacting, but you don't have a mechanism yet. Pre-IPO, failure is really common, which means startup founders are often taught and cultured to believe that getting to the IPO is the first thing that they need to do. On top of which, this isn't a government policy banning people from remaining CEOs after the IPO happens, but rather a norm change.
That's time. Two things. The first thing is, if the risk of failure is high, and the main thing this person wants to do is have the company succeed, then getting pushed out, meaning the company does not succeed on their own terms, is still a strictly bad outcome. Secondly, if this person is also profit motivated and would like to get money, anybody who can IPO presumably also has the option to sell their company or partially sell their company to a private equity firm or a VC firm, yes, at a marginally higher cost of capital, but if you have trillions of dollars on the sidelines willing to chase your company, you can certainly get billions. That's the likely alternative. You will get capital. It's just a question of whether you face regulation. Second thing in this speech, this extremely weird argument at the top of Tejas' speech that, oh, you're just going to get forced out after a month instead of leaving. I just want to quickly address this argument. The first thing I would say is this is not in the spirit of the motion. If these people are getting forced out every single time consistently, I don't think that is the same as saying there is a norm where the CEO stays after the IPO. That's just saying there is a norm of backhandedly the CEO leaves after the IPO. Second response, norms move averages. If the norm is that people stay most of the time, then on average, the number of force outs will also go down, because there's obviously an expectation from the market that if you give people time, that can be something that is valuable. Whereas if most people are replaced, then the few people who do not want to get replaced are far more likely to be forced out. So that easily flips that point. Third thing in this speech, let's talk about the incentives of founders and the long-termism, short-termism debate for companies that do IPO. But I just want to make it clear that this is a far less weighty impact than what we've already won in this debate. They've made a few responses. We're not taking another from you. They say investors have good incentives to be long-termist because of like literally the way that assets are valued, that you have to care about long-term future dividends. This is a ridiculous claim for a couple of reasons. First one, the technical claim is the discounted present value of expected future dividends, which means that every year further out it is, the less weight you place on it. And right now, for example, when interest rates are 5% and climbing, that discount rate is pretty freaking high, which means that you always want to make profits now versus betting on something that could blow up in the future. All the tech companies Arthur cited in his POI, all of their stock values have collapsed overnight because they were being long-termist and because the market has started to kowtow to the short-termist tendencies of the day. And the only way that we can ensure that innovation persists through that environment is by having the innovators in charge. Second response, they say companies are going to want to be very ESG focused and focused on social responsibilities. Take you first, yeah.
Why is innovation and a profit-making incentive mutually exclusive? I think we see a lot of innovation in like terms of green tech because it is the ability to make profits.
Certainly when these two things overlap, it is good and they would happen outside of the house. But I think that the public markets in many cases will have contradictory incentives because there's a trade-off between short-term and long-term profits. The distinction we're making is that these large institutional investors that are deeply liquid, that can trade securities in milliseconds, don't really care about your profits 5 years ahead, because if they maximize profits this year, even if your next 4 years profits will be bad, they'll just sell it, and then they'll buy something else and maximize profits there for a year, and then they'll sell it, and they'll keep doing that. And there's a huge amount of retail investors in Robinhood who are willing to buy those stocks, and they'll eat that up because they lack the information about the way these companies are being juiced, and that's exactly the reason why all of the major companies in the United States of America, companies like Apple, companies like GE, have moved away from R&D expenditure and moved towards financializing their balance sheets, where all of the profits they earn, they just put them back into the public financial markets and buy and trade stocks. They don't actually try to change the world and create new technology. We are a counterweight to that. The next thing I want to say here is that in terms of like ESG and pension funds and whether or not you have responsibility to society, there are huge ways to get around this if you care about profits, right? The easy response is like, you'll invest in green companies, but you won't invest on incrementally green practices within those companies, i.e. changing prices instead of changing innovation strategies. Final point on weighing here. There may be some cases in which this kind of long-term moonshot strategy is going to be bad and fail, but we're living in a world of increasing monopolization and consolidation, but it's very, very hard to take down entrenched incumbents. So the probability being, even if there's a 5% chance that one of these moonshots succeeds and brings the price of a medical procedure in half or saves lives, that is a risk we're willing to accept.
I think the deal after that speech, I invited the member of government to open the forum back up. Hear, hear.
Starting my speech in 3, 2, 1. The first question that I'm going to be answering in my speech is why are companies still likely to opt into IPO? Even though being charitable to opening opposition, this is not a like policy change bit, it's just a norm change, unclear as to why companies are just going to suddenly stop opting into IPO. 3 reasons, right? Number one, a lot of companies opt into this on the basis that they are failing. That's why we see companies like Uber and Twitter opting into this, the point at which they feel like they can't make money anymore. I would argue that that is still a very likely scenario for most companies, even though they are large ones. That is why it's still necessary. But secondly, the need for growth, I think that there is a natural incentive for companies to tap into different markets to get the money that's necessary in order to grow in a way that's not just one-dimensional, but to grow in different areas as well. Thirdly, on internal push, I am quite certain in believing that within board of directors there might be push and pressures that is due to people losing confidence in this particular individual. I think that is the point at which people will still opt into IPO in order to get the money that's necessary, in order to gain back the confidence of people within the corporation, but also from consumers, right? That is why people are still likely to go opt into IPO, not just going to change at the point at which we oppose this particular norm. But that is how we're going to properly enter this debate as side of closing government. Because I think that the profit incentive nature of shareholders is something that actually gives the company a boost, and that is an incentive that matters. Because more money means better ability to reinvest into the company, which I would argue is likely much more likely to boost innovation. But secondly, it's better welfare for in terms of worker welfare that's better taken care of as well, right? Because you're not just going to make risky long-term investments that screw over the workers of your company in the long term, which is something that side opening opposition refused to deal with. But I want to also respond to the point of losses, and this is where they argue about the fact of how you're more likely to have these founders thanking the losses because, I don't know, they love the company or something like that. I would argue that it's more likely in our world that you have a better ability to thank losses, because given the profit incentive of shareholders, I would argue that they're more afraid of losing losing that money, as opposed to individuals who in your world who will argue that this might be the calculated decision in tanking the losses, but are probably just going to make more risky decisions on the basis that they can tank these losses. On the basis that they can tank these losses, but then later it translates to them cutting salaries for individuals within the company, right? So it's more likelier that you're in a position where you have to tank losses even more in the world of opposition, as opposed to in our world, where shareholders are unlikely to make the decisions that require them to tank losses in the first place. But that is where I want to bring in three extensions, right? Number one is that's the need for professional management. Understand that the company is entering into a new phase that recognizes the need of change and recognizes the need for new directions, right? This is the point at which I would argue there is a necessity for the different set of skills that is like different from what the company currently has, right? What can professional managers offer you that is unlikely to be in the hands, or unlikely to be like part of the skill set of these past founders? Number one, in terms of experience, shareholders have a much greater incentive in hiring professional managers that have experience in dealing with large complex organizations, as opposed to just randos who have like money and like white men who had the capital and privilege that's necessary in order to start this company. Secondly, they're more likely to have the skills that's necessary due to their experience. And thirdly, it's incentive, right? That these are individuals who are probably going to want to work for the company on the basis of growing it and on the basis of moving it into the direction that actually matters in the future, as opposed to in your world where it's just an emotional attachment or this idealized version that they talk about, which I'm unclear as to why this particularly aligns with this new direction that this company is having, right? And that is something that's uncharacterized by the side of opening opposition, and that's a problem, because if you don't prove why these idealized versions and why the emotional attachment that these founders have to companies is not going to be outdated, it's not going to be of past ideals that no longer are applicable in the status quo, I would argue that is when the point at which your business is more likely to fail. And that's the example that we see with Jack Dorsey, right? Who is nobody in terms of social media expertise, and which is why he was faced great internal pressure in like giving up the company and like selling it at the end of the day. And that's the point at which you create more instability within the company, where a lot of people are then harmed in the process of this change of leadership, as opposed to it something being natural, where the point at which you opt into an IPO, then the founder says, you know what, I'm stepping down. That creates a more natural process. But this is the point at which I also want to respond to the idea of innovation that we hear coming from opening opposition. They say innovation is more likely because of this idealized version, and because you want to push this company into becoming like great in the eyes of the public and the eyes of like, I don't know, your shareholders or whatever, right? And I think I pointed this out in my POI, that innovation and money can coexist. They're not mutually exclusive. But I would argue why this is much better in our world as well. Because number one, I think this is when we have individuals who are actually innovating that's something that has value in the market and something that people need. Because the point at which you make the decision to innovate, this is on the point of need and on the demand of consumers, right? Whereas in your world, you're just probably going to invest in like getting to fucking Mars or something, which means nothing in the long term to individuals, but it means a lot to this one individual because that is how he idealized the company. That is when your long-term innovation plans are more likely to hurt people in the short term and more likely to screw over the employees within your company and the workers within your company. That is why it's bad. But why can two of them coexist then? Before that, I'll take a POI.
Yeah, I feel like this entire argument is premised on a mischaracterization of pre-IPO companies. These aren't like shit show startups in someone's garage, right? These have taken several rounds of investment from venture capital, from growth funds, and now they're IPOing. They have professionals.
I mean, the way Twitter was is like akin to a shit show in a like garage, right? So I'm unclear as to why that's happening, because the point at which you make the decision to opt into an IPO, I would argue that there is a necessity to do so. There is still some degree of problems there. Closing.
Yeah, the thing is that all these CEOs who have like vanity projects, they need to fund these vanity projects in some way. So even though they do this, they also make very sensible decisions in other parts and sections of their company to make sure
but
it's
that's
still profitable.
exactly the problem, right? That the CEOs with their vanity projects constantly change, which is why as Elon Musk, I'm willing to take like ballsier decisions with whatever company I'm running, because I know that I can lose money because I already have businesses in other damn areas, right? Which is why they're probably more likely to trade off this one company because they have other vanity projects that probably mean more to them in the long term. But why can two of these things coexist? And that's because of number one, of explicit power, that you're more likely to have individuals with cult of personality that influence how people make the decisions in board meetings in terms of like the direction and the growth of the company. But it's also the implicit power, implicit influence, right? That the fact that this person is present in board meetings means that it's hard to talk about why this company is a shit show. It means that it's unlikely that we're going to make brave decisions in moving forward within the company that's necessary in order to push the company forward. Then I want to also talk about why the comparative. So the comparative is here that you're less likely to to have a succession plan, it's more likely the company is going to suffer in the future. But here's where I want to talk about diversity. And the premise of this is many corporations are started on the basis of privilege, where white men who not just have money, but the connections and reputation that's necessary in order to participate in this structure. When C-suite individuals remain in this position, it's more likely that the leaders are going to maintain the homogeneous nature of this company for all the reasons that they told you. Number one, personal ties. Number two, ingrained biases. But why are stakeholders likely to make the more inclusive decision? It's number one, to appear more attractive to different groups of stakeholders, but number two, to maintain a public image, right? That is why in the world of opening opposition, you're more likely to have the Twitter situation where Elon Musk just doesn't care, fires individuals who are tied to visas, and that's where you have a worst off decision in terms of corporate structures. So proud.
Here. I thank the member of government and remind everyone to take time. I invite up the member of opposition. Here.
Panel's ready? Couple of things in this speech. Firstly, extraneous responses to the extension of closing government, and then 3 main points of extension. Firstly, why these founders are actually critical for maintaining continuity within a company after initial IPO. Secondly, the norm that Gov have to defend and why that is incredibly uncertain and likely to deter investors into the IPO in the first place. And then thirdly, the long term, dealing with OG stuff on it's harder to force these people out, the cult of personality shift. In terms of the extensions out of closing government, I think you say 3 things. Firstly, there is a need for professional management. 1, this is in OG. Secondly, I don't think they have to keep everyone, right? Like you could probably keep this, like in terms of the founders, you could probably keep the CEO, the CFO, the COO, but maybe you'll get a new CMO in or somebody else. It's unclear why all of the C-suite roles have to be filled by all of the founders. I would note that many companies just don't have enough founders to fill all of these people, to fill all these roles in. So I think there are probably new forms of professional management coming in other ways. Even if you don't buy they're going into C-suite roles, investors can move on to the board and can influence in other ways to provide all of this experience and expertise. It's unclear to me why you need specifically new people in all of the C-suite roles, which is what Gov have to defend. Secondly, they say some stuff on innovation. I'm really unclear on whether it's CEOs who on their side of the house are professional managers and not ideas people. They're actually doing the innovation. Innovation probably comes from engineers or people further down the supply chain within these companies. These people need money insofar as our arguments are going to show why you get more money and you get better stability over the short term. That will solve for the innovation class. The last thing they say is on diversity. I don't think there's a lot of time spent on this. I think it's probably lacking in terms of impacting and importance and weighing within the round, but just extraneously, I think this is to some degree solved by the responses early on the professional management stuff. You could probably bring some people in. I also don't think they explain why the people you would bring in would not also be white, male, pale, and stale, given these people also exist on Wall Street. No, thank you. Characterization. For a lot of the reasons that OG give about what these people look like, I actually think in the majority of instances, a lot of founders have moved on from their companies before they even get to IPO. Why? Because they're burnt out. Because they want to set their ideas free. Because a lot of them are always serial entrepreneurs that just want to move on to the new thing. I think what that means is that the scenarios where we're talking about, where you have founders still in the company that are moving to IPO, is actually a smaller set of scenarios where these founders are actually like to 1, genuinely care about the company, or 2, genuinely have a unique vision that nobody else could bring in. Note that I think that in and of itself responds to a lot of OG stuff on these people are bad. But here's some more stuff. I actually think these people are incredibly critical in the short term after IPO. Why? For 3 reasons. Firstly, they provide you continuity of direction. That is to say, they have a vision, they pitch that to the market for the IPO, and then they move, and then they get to carry out that vision after the IPO. OG here say that, these people don't evolve. 1, I think this is to a degree unproven. Insofar as my framing shows why these people are likely to care, they are likely to evolve in order to be able to show that they care and to actually carry that out. Secondly, I think insofar as you have new shareholders on board, you presumably have at least 1 or 2 new people on your C-suite for the responses I gave earlier. You actually do have people who can push for the evolution. But thirdly, no, never mind. I think then the second reason here is that when you have company founders that have been with the company for all of the company since its foundation moving into the IPO, these people have like a wholesale knowledge of all the facets, all the people, all of the moving bits within the company. That's critical because that means that if you get new people in on their side, there is a time lag where they have to learn the company, they have to learn what it does, learn how it works, etc. Which means the whole thing slows down because they can't implement a direction without it fucking up the company because they maybe don't understand stuff and make bad decisions. The third reason here is that for the framing I gave earlier, that these people probably actually care about the thing that they're doing, they probably then also care about society. They only cared about money and like massive growth is what OG and CG to some extent characterize. I think they would have just become stockbrokers or some other stuff, or become a CEO and moved into another position in a company that already existed. What is the impact, not right now, what is the impact of this? I think that means that IPOs on our side of the house are more likely to be successful. Why? Because you get that continuity, that means that there is not a time lag, there is not a degree of disruption. That is critical because if you have that time lag and if it looks like things are shaky over the short term, that is where all of the investors into the IPO start to flee, start to think I might not actually put as much money in as I wanted to because they think, oh no, maybe this is actually not going to go in the direction that I wanted to. That is why certainty is the critical factor within this round. OG.
It's the continuity of direction that leads to time lag because these founders are now managing a fundamentally different company with different financing at a scale up. We want an experienced CEO coming.
No. I actually don't know why that is necessarily true. Like, insofar as these companies are doing a thing, selling a product, etc., I don't know why that then all of a sudden has to change at the point where they now just scale up the size of the company. No, thank you. Then, let's talk about the norm that that government bench have to defend. Because if there is a norm where investors have an expectation that founders will stay on, then presumably the corollary of that is that on their side, there is now a norm that would have to exist where people expect that these people don't stay on and move on. Why is that really bad for the IPO in and of itself when that norm now exists? Because it now means you've got investor uncertainty. Investors are looking at whether to invest in the IPO, and they have no fucking idea who the CEO is going to be going forward. They have no idea what the vision is going to be, because it's after the IPO, the founder is going to walk out the door, and you don't know who's coming in. If that's true, then I don't know how they get the same amount of investment in that we would get on our side. That means that you slow down the company even more, that puts jobs at risk, that puts social progress at risk. Close it.
If they are needed for continuity, but you claimed earlier that they generally leave before they go into an IPO, which is true.
See the framing, which is that there are some people who will set it free, but the people that don't go free, the people that don't move on, are where the instances where it genuinely matters that the founders stay in. I don't think you listened to the framing correctly. Lastly, on the long term, OG say that it's harder to adapt and that you can't force these people out. On the harder to adapt point, they say here that there is experience. One, see all of the stuff about there is a new board. Secondly, they say that there is a high growth mindset. I don't know why this is a bad thing. Like, growth insofar as it makes companies bigger and it collects more tax revenue and it gets more jobs is probably a good thing. Like, explain why bad things are bad, please. But secondly, why is this actually a long-term good if it is actually so hard to push these people out? One, I actually think you get accountability between the founders. Like, it's unclear why they all think and sing from the same hymn sheet. I presume there is some degree of discussion between them that keeps the company moving on insofar as they all have a founding stake within this. Secondly, they just have fiduciary duties now at the point where they're public to actually, make money and do good things. But thirdly, insofar as they're harder to push out, one, I actually don't think OG ever proved that this is true. I don't know who the cults of personality are other than Musk. I don't know anyone else. But even if that's true, good, because it means you get more consensual decisions rather than just thinking, I will push out the CEO and my problems are solved.
Here. I thank the member of opposition for that speech, and I invite the government whip to close the debate out for side talk. Here, here. Here.
to start by dealing with side closing opposition and why is it that the extensions don't weigh in terms of the arguments that Asan gives you. I'll also discuss what is it that the extensions that came up from Asan and how is it that it weighs up to opening government, because I think there were better mechanizations of the outcomes if the positive, and how is it that we do extend the debate in side closing and then deal with side opening opposition. So let's deal with closing opposition. Side closing opposition promises 3 extensions, but they only successfully deliver 2 extensions. The first idea is the entirety about the continuity of direction, and why is it that there's some level of continuity if these founders were to stay in place. So I think I want to just take out the part that is not contentious. So it is directive to stay in power, and the new company that is under IPO is going to go by the exact same directions and etc. I don't think that's really part of the debate, because if this knowledge is going to be 100% in line, in tandem, and it's going to be great for them, then there's no clash of incentive that exists. But we're talking about situations where there's a clash of incentive. I think it's already explained why there exists a clash of incentives from OOG, but Asan also talks about it further, about why when it started off as a startup or a private company and it moved into a public listed company, there is a difference in terms of the incentive structures of how the company moves and operates, which is why if there's a tension in terms of what the ideals of these founders are and why this is intention to them, that's going to be a problem. I don't think CEO was ever once charitable to dealing with this probability of there being a tension that exists, right? But second, just in terms of there's also this response that if you want to have other CEOs to come in, that it's easy for them to you can have some level of other individuals coming in and assisting this founder director, because at least if they're on board, there's some level of the continuation of direction and certainty. But this circumvents whatever Asan talked about. When Asan talked about the need for professional management, which I think the member of OP just very quickly dismissed it by saying this derivative of opening gov, but it's not. We talked about 3 different levels of explanation about how this professional management are different compared to these founders, right? The experience that they bring in, the skill set they bring in, and the incentive structures that they bring in. These 3 things show that because it's a different ball game now in terms of how this company now operates as an IPO, it's needed for them to be in power. But second, just to deal with the question about why don't you just add another CEO or CFO, it can't exist for the same reason Asan also explained to you. You can't have a founding CEO and another additional CEO in power, because there are 2 reasons as to why there will always be a tension. Either explicitly, this founding CEO can have a veto power or have more say or more votes because of the fact that he is a founding partner, or second, implicitly, even if everything is the same, the fact that this person is in a discussion, in a boardroom meeting, discussing with other shareholders and saying that, no, this is the direction the company ought to go to, when every other shareholder or every other CEO that you add on is contrary to that. These are the circumstances in which that will always exist when you have a founding CEO in power in discussion, right? So which is why the entire discussion about why there always has to be a continuity in the direction is not proven. But second, it is far worse in situations when there is a clash. But second, in terms of investors, so I think this is perhaps the biggest contribution that they bring on. But the entire part about investors is there's the idea about certainty. If we were to remove the CEO, founding CEO, and appoint no one at all, and there's a power vacuum, then it's uncertainty. But there's no uncertainty on our side. There's always going to be the professional management that Asan spoke about all these individuals you experience. You can always replace them. You can have an open tender for a CEO or CFO to come in. You can hire a CEO from another place to come in. There's no uncertainty here. There's always going to be a certainty that exists. As a matter of fact, investor confidence will be higher because it knows that this company is willing to be permeable, to be flexible, to change, to adapt to the different circumstances. So investor confidence is far worse on their side when it's always rigid, when the norm is an expectation this person will always be in power, as opposed to the flip norm that this person will leave. Because that also deals with the idea of norms that CEO talked about. That it's better an outcome for investors if the norm would be flipped than the contrary. I don't think side closing opposition extension holds any weight in this debate. Please sit down. But I want to talk further about what Asan talked about, because there are 2 additional things. There's one part I already talked about, the professional management and also why they can't exist together. But the third part on succession, because when you talk about longevity of the company, which I think OG already alludes to, you're talking about succession. What's the long-term plan? Who are the individuals going to come in next? When you have a founding CEO, there's always an expectation there's always going to be this person, there's going to be the top management or the person in charge. When there's no succession plan of what happens in the long-term plan. Things like this can only exist in a world where then you have got a professional board management where people are always willing to replace people or hire new people in different positions, because a succession plan is what makes it best for shareholders to look at the longevity of this company. But last bit on diversity, the only response they had on diversity is you can always hire another white guy. Yeah, sure, that's not comparative. Which side are the board of directors or board of shareholders more likely to hire people of diversity? Is it when you have a founding partner with fixed ideals and fixed mindset of how the company ought to go, or shareholders that are more likely to look into inclusion of looking at different markets to go into, because profit is what they're going going for, it's more likely for diversity to happen on this side as compared to that side. Yeah.
Yeah, you misrespond to our case. On our side, I know who is going to be the CEO. I can have a chat with them. I can influence them. On your side, I have no idea who that's going to be, what they want to do with the company. On which side is investment therefore more likely?
No, you can always know who the CEO is going to be. He just will not be the founding CEO. Yeah.
Neither Gov team has substantiated a real impact beyond things like investor returns and certainty. We are not Wall Street investors in this debate. We actually care about society, things like moonshot drug
Okay,
development.
I'll give to society, but also investor confidence and all is part of the debate, which is why we're talking about it. Let's go to the discussion of society, also dealing with opening opposition. So I think opening opposition's biggest contribution in this debate is discussing about incentive structures and why is it that on our side, somewhat there's a short-term incentive structure compared to them. So I think incentive structures are very much simple. The founding partners will have an added, shareholders will always have the incentive structure of making money because they're pumping in money, they want to make money back. But the founding individuals will have an additional incentive, which is to maintain their image, their ego, whatever their company, their startup, right? So this incentive structure clouds the perspective of these individuals to make long-term calculated decisions. So it is also true for OO to consider that sometimes these people can cash out at any given time. The ability for them to cash out also means that there is no incentive for them to look at long-term incentive. But the flip side is shareholders will always have an incentive to look at long-term. Why? These are individuals that just bought on shares onto this company that they just came on board. So they have not made returns on whatever money they put in. The flip side is a founder has already made his money and they easily pull out, right? And in terms of innovation and R&D, if innovation and R&D leads to money, it will most definitely happen because money and profit is the main idea here. But second, they also have an added incentive to do whatever R&D that takes to better society because public service is also something to go for. Meaning to say they can move companies from in-store to e-commerce, green practices or packaging and etc. Because these are the more palatable terms, the more in and sexy terms for them to make money. Business models like this already exist. R&D is always an incentive, especially if it's backed with money, right? But second, in terms of the future of the company, I don't think I think Asan gives you 3 reasons why companies will always go for IPOs. I will take on the worst case. Even if they don't go for IPOs anymore and the norm is going to be loans and etc., it's okay. Because if a founding partner is going to be and going to run an IPO the same way he runs a private company, it has worse repercussions to shareholders and the market industry in of itself. We think that's a worse of harm. We're happy to work on a side where the norm is not founding partners. Thank you.
I think government whip, and I invite up opposition whip in the debate as a whole. Hear, hear.
Okay, starting in 3, 2, 1. Closing government claim it is much better to have a new CEO and someone else with a different set of skills because they are likely to have more experience in this field because they are likely to have been a CEO beforehand and therefore they have skills in large company organization. Large companies have similar things in common, like they have benefit from economies of scale, but the actual day-to-day structuring and how they run can be incredibly different. Not all skills are completely transferable to new people. You will have teething issues such as like a culture in one company can be radically different from the other. The way that you talk to your staff, how often you email people versus having face-to-face meetings, all of these things make things incredibly difficult for someone in that field. But also you don't just always have the same skills. Like you can't just go from like global shipping to a tech company. There's like different things and the ways that you interact with those markets specifically. You do not always have the knowledge for in that way. I think that they also say, oh, but you always will have a new incentive because you will want to grow the company more. I think this weird thing on innovation and growth is really symmetric because presumably, even if you do vanity projects or you have a vision and a final idea for the company, which maybe in the short term is not that profitable, you know to get there in the long term, you need to be profitable in the short to medium term because CEOs and founders of companies are not idiots, so you will do both things together. You will not just explicitly go towards one thing. I think they give you a lot of example analysis of like big occasions where this has happened, like the CEO of Google or Elon Musk or things like this. This is not within the debate. These are the biggest companies and one-off examples that you're talking about. Millions and millions of companies across the world. I think the CEOs and the actual founders of them don't do things like vanity projects. They just care about them. But I also just want to point out that a lot of the time CEOs, which are coming in from external places to these new companies, often get pay rises or bonuses when the company does badly because it is in their interest. Because when the company does badly, they don't want to have have a change of management, so therefore they pay them more to make sure they stay on and can make sure all the investors stay calm and don't leave. So I think this means that actually like CEOs often have perverse incentives which don't always align with the same with stockholders and shareholders or like how well the company does. They then say, oh, I think I've kind of dealt with the innovation point to some extent, but I think I'm just like going on to the skill set, and this deals with like government bench as a whole to some extent. But I just think when they say, like, I think continuity is the most important thing in this point, because you can get advisors, and I just think they say, oh, but, and this comes mostly from opening government, they go, oh, but you have funding differences now, and the way that money goes out, it doesn't just go all back into your bank account or reinvested, it has to go to shareholders, right? I just think where the money comes in and the money goes out changes. I don't know why that's so difficult for a founder CEO to still then make sure the company works on a day-to-day, because presumably to get to an IPO, you had to have been reasonably profitable or doing reasonably well. And also, I think, crucially, I think you, as the founder of a company, figure all of this out before you go to IPO, so that when you go to IPO and you are trying to attract public people to invest in your company, you can show them a plan of how you, as a founder of the company, do have this expertise, you have a plan going forward about how you know this is going to change the structure of your company and how you will be able to do it. I think this is just true because you need to get people how to invest and like show that you will be able to do this competently and you would be able to do this would be able to do this specifically. I think that weighing over opening opposition, I think the short term is incredibly important for brand new IPOs, because I think like changes of management are often necessary in companies, and it is just sometimes people retire and it's time to leave. But when you're a brand new IPO and you're not very established, you're trying to get in these new investments, you have to do this quickly because you need to do this. Because I think what happens otherwise is that what you get is like you get like a Minsky moment, and that people like start to get nervous and they pull out. Because I want to also point out about opening opposition. They say they have two cases. First of all, they say, oh, the comparative is that you benefit society. The second one is you get more capital for the company. I think if the C-suite is as good as they say they are, and they're so much better as described in their first case, then I don't think actually going public is like so bad, because their second case is basically these companies won't go public. I don't know why then that's so bad if these like people don't like if they're good CEOs and good founders, they don't need the accountability mechanisms you get when you go public. So I think their second case is mitigated by themselves. Yeah, go ahead.
Founders often wholesale export the cutthroat management practices of a startup to this larger company. This means aggressive cost cutting, moonshots that lead to layoff, and monopolistic practices for which they can't be held accountable due to their position.
Right, but I think this is also very likely on your side when you have uncertainty and your stock value goes down. Because the thing is, when you shift a norm, and even if it is not the norm that like the founder is removed, right, you still get on aggregate more uncertainty, because even though it's a norm, you can still be uncertain about things. Like for example, if like keeping a founder means that there's a likelihood of failure of like 1/5 across the market, that just leads to a 1 in 25 chance it will fail. But if you're like if that's keeping a founder. If removing a founder is like a 1 in 3, then you still then have a 1/9 chance of failing, which is a larger one across the market, which means people are scared. I think the short-term impact is the most important thing in this debate for a new IPO, because I think that stocks, and I can't stress this enough, are so incredibly speculative and not based on any real events or actual proper full information, right? Shifts happen incredibly quickly, and I cannot stress this enough in the current day. You have silly little trading apps like Trading 212, which means any random punter off the street can download and invest in your company or pull out at any random moment with very little cost to them. Chats and WhatsApp groups, tweets, IA tracking of like stock prices means that everybody has as much information on what the prices are going, and so they can see things going down very quickly all of the time, but they might not know the reasons for this, which means that as soon as you have even a slight degree of uncertainty because you're removing the founders, this is different. Because the chats that you're having in WhatsApp conversations with these stock holders are people that are like talking about who's being nominated for this position, who's applied for this position, who's voting for who, and which way it will go. I think this is what then leads to the Minsky moment, which means that you it just means that people take out and pull out funds. They've invested initially because they believe in this founder, they then pull out because they realize they are leaving because the norm has changed. This just means that like companies either fail or like less like extremely, they cut costs, they lay off workers, all of the bad stuff that we've agreed is generally the metric of the debate. Closing.
If stocks are fake and economic structures do not exist, why wouldn't you rather have individuals that are more aligned and in tune with this fake structure as opposed to CEOs who probably don't care about this?
I kind of already done this. I just think like, and this isn't Alexander's characterizations, I think people do care about this. I just think if you were rich, or you wanted to be rich, you'd be a stockbroker. If you become a founder of a company which involves a lot of personal risk and your own capital, it's because you probably have a vision and you actually like it and care about it. Cool. Okay, going on to opening government and explicit rebuttal. Cool. I think they say, oh, shareholders are better because often these are large, like sovereign wealth funds or pension funds, and they represent their customers. To be clear then, this is not society, and often the best thing for their customers is not what is best for society, because you can exploit others to make sure that your customers get gains to this, which means that they are not going to have what is the best interest for society, but just what the company can do to make sure that there's a lot of funds for them to go around. They then say, oh, and they own a lot of companies though, so they want stability in the market, so they will not do anything stupid with this company. I think the reason they have lots of stakes in companies is because they have a diverse portfolio, which means they can manipulate the tech sector to make their stocks go up and the rest of it unstable, but they'll be fine because they have lots of stocks in like the housing sector, which means that it's fine. I think actually these people are much more likely to make risky decisions in the stock markets than like a founding CEO who is already there and in place and has a lot of influence. Which I think that means. I think that the cult of personality thing, they say literally in the beginning of the PM, they say it looks bad to put them out. This is what influences stocks and stock prices. This is why you need to keep them the same and stable. All these reasons, CEO.